You have been contributing to your 401k for 5 years. Every paycheck, money goes in. You check the balance, and it is $20,000. You do the math. 5 years, maybe $12,000 in contributions, plus employer match. The numbers add up, but it does not feel like it is growing. It feels like you are filling a bucket with a teaspoon. You wonder if this is even worth it. Here is what nobody tells you when you start a 401k. The first $100,000 is the hardest part. Not because you are doing something wrong, because that is how compound growth works. For the first decade or more, your contributions are doing all the heavy lifting. Your investment returns exist, but they are small compared to what you are putting in. Then something shifts. Around $100,000, the math flips. Your account balance starts generating more growth than you are contributing. That is when it stops feeling like a teaspoon and starts feeling like a fire hose. This is educational, not personal financial advice. Let's start with the data. The average 401k balance for people under 25 is around $6,900. By your late 20s and early 30s, the average is $42,640. By your late 30s and early 40s, it is $103,552. Notice the jump. It takes over a decade to get to $40,000. Then it less than doubles to get past $100,000. But once you are past that mark, growth accelerates. By your late 40s and early 50s, the average is $188,643. By your late 50s and early 60s, it is $271,320. The growth is not linear. It is exponential. And the inflection point, the place where it starts to feel real, is around $100,000. Here is why. Let's say you contribute $6,000 a year to your 401k, and your employer matches 3%, adding another $3,000. That is $9,000 a year going in. If your investments return 8% annually, which is close to the historical average for a balanced stock and bond portfolio, here is what happens. In year 1, your $9,000 grows to around $9,720. You gained $720. In year 10, if you have been contributing consistently, your balance might be around $110,000. That year, your 8% return is $8,800. You contributed $9,000, but your account grew by over $17,000. For the first time, your growth is close to matching your contributions. By year 15, if your balance is around $180,000, your 8% return is over $14,000. You are still contributing $9,000, but the account is growing by $23,000. Your money is working harder than you are. By year 25, if your balance is around $400,000, your 8% return is $32,000. You contribute $9,000, and the account grows by $41,000. You are not doing anything different. You are contributing the same amount you always have, but the account is generating almost 4 times your contribution in growth. That is the power of compound growth. And it does not feel real until you cross that first 100,000 threshold. Here is the psychology. When your 401k is at $10,000 or $20,000 or even $50,000, the annual returns do not move the needle. You contribute $5,000. The market goes up 8%. You gain $4,000 in growth. Total increase is $9,000. It feels incremental. You are still the main contributor to your account. But at $100,000, 8% is $8,000. Contribution plus growth equals $17,000. You can see it now. The account is pulling its weight. That is why the first $100,000 is the hardest. It is not that you are doing anything wrong. It is just math. Compound growth needs a base to work with. The bigger the base, the more powerful the compounding. In the early years, you are building the base. In the later years, the base is building itself. Let's talk about how long it takes to get to $100,000. If you contribute $6,000 a year with no employer match and earn 8%, it takes about 10 years to hit $100,000. If you contribute $9,000 a year, including an employer match, it takes about 8.5 years. If you contribute $12,000 a year, it takes about 7 years. The more you put in early, the faster you hit the inflection point. Here is where most people mess up. They contribute just enough to get the employer match, then stop. Let's say you make $70,000 a year and your employer matches up to 4%. You contribute 4%, that is $2,800. Your employer adds another $2,800. That is $5,600 a year total. At 8% growth, it will take you about 11 years to reach $100,000. Not bad. But if you bump your contribution to 10%, that is $7,000 from you plus $2,800 from your employer, total $9,800 a year. You hit $100,000 in about 8 years. You shaved 3 years off by increasing your own contribution by $3,200 a year. That is $270 a month. For many people, that is doable. Now, let's talk about contribution limits. In 2025, you can contribute up to $23,500 per year to your 401k as an employee. If you are 50 or older, you can add a catch-up contribution of $7,500 for a total of $31,000. If you are between 60 and 63, the catch-up is $11,250 for a total of $34,750. These are the employee contribution limits. Your employer can contribute on top of that. The total limit for employee plus employer contributions is $70,000 in 2025. Most people are nowhere near maxing out. The average 401k contribution rate is around 7% of salary. If you make $70,000, that is $4,900 a year. Add a 4% employer match, and you are at $7,700 total. That is fine, but it is slow. If you can push your contribution rate to 15%, that is $10,500 from you plus $2,800 from your employer. You are at $13,300 a year. You will hit $100,000 in about 6 years if you are starting from zero. That is the difference between slow accumulation and aggressive wealth building. Here is the trade-off. Contributing more means less take-home pay now. If you are living paycheck to paycheck, maxing your 401k is not realistic. But if you have any margin, any flex in your budget, the first place that extra money should go is your 401k up to the employer match, then beyond it if possible. Because every dollar you contribute in your 20s and 30s has decades to compound. Every dollar you delay costs you years of growth. Let's run a scenario. 2 people, both 25 years old, both making $70,000 a year. Person A contributes 6%, gets a 4% match. Total is $7,000 a year. Person B contributes 15%, gets a 4% match. Total is $13,300. Both earn 8% annually. By age 35, Person A has around $100,000. Person B has around $182,000. By age 50, Person A has around $390,000. Person B has around $715,000. Same income. Same employer match. The only difference is contribution rate. Person B retires with almost double the wealth. This is not about being perfect. This is about understanding the math and making intentional choices. If you cannot contribute 15%, contribute 10. If you cannot do 10, do 8. Just do more than the minimum if you can. Because the goal is not to hit some arbitrary number. The goal is to hit 100,000 as fast as possible so compound growth can take over. Now, let's talk about asset allocation. How your 401k is invested matters. If you are in your 20s, 30s, or 40s, you should be heavily weighted toward stocks. Stocks are volatile, but they have historically returned around 10% annually over long periods. Bonds are safer, but return around 5 to 6%. If you are young and your 401k is in a conservative bond-heavy portfolio, you are leaving growth on the table. You have decades before you need this money. You can afford to ride out market downturns. Most 401k plans offer target date funds. These automatically adjust your allocation as you age, starting aggressive and getting more conservative as you near retirement. They are not perfect, but they are a solid default. If your plan offers a 2060 or 2065 target date fund and you are in your 20s or 30s, that is a reasonable choice. It will be about 80 to 90% stocks early on, which gives you the growth you need. Here is a mistake people make. They see the market drop, panic, and move everything to bonds or cash. They lock in losses and miss the recovery. The best thing you can do in a market downturn when you are young is keep contributing. You are buying shares at a discount. When the market recovers, which it historically always has, those discounted shares grow. Trying to time the market is a losing game. Staying invested and contributing consistently is the winning strategy. Let's talk about Roth versus traditional contributions. A traditional 401k means you contribute pre-tax dollars. Your taxable income goes down now, but you pay taxes when you withdraw in retirement. A Roth 401k means you contribute after-tax dollars. You do not get a tax break now, but withdrawals in retirement are tax-free. Which is better depends on your situation. If you are young and in a low tax bracket now, Roth can make sense. You pay taxes at a low rate today and avoid paying them at a potentially higher rate in retirement. If you are in a high tax bracket now, traditional might make sense. You get a bigger tax break today. Here is a rule of thumb. If you are making under $70,000 and expect your income to rise, lean toward Roth. If you are making over $100,000, traditional probably makes more sense. If you are in between, it is a toss-up. Some people split the difference and do half Roth, half traditional. There is no perfect answer. The important thing is to contribute. Do not let the Roth versus traditional debate paralyze you. Now, let's talk about employer match. This is free money. If your employer matches 4% and you contribute 4%, they are giving you a 4% raise. If you are not contributing at least enough to get the full match, you are leaving money on the table. That is the first priority. Always get the full match. After that, if you have high interest debt, credit cards above 15%, it might make sense to pay that off before increasing 401k contributions. But if your debt is lower interest, like a mortgage or student loans, keep contributing to the 401k. Here is why. Let's say you have a student loan at 5% interest. You are deciding whether to make extra payments or increase 401k contributions. If your 401k is earning 8%, you are better off contributing to the 401k. You are getting an 8% return versus saving 5% in interest. Plus, the 401k contributions are often tax deductible, which makes the gap even wider. This is not always true, and everyone's situation is different. But in general, if your debt is low interest and your 401k is earning historical averages, prioritize the 401k. Here is a framework. I call it the Retirement Compound Growth Ladder. Rung 1 is getting to $10,000. This is the foundation. It proves you can save consistently. Rung 2 is hitting $50,000. At this point, your annual growth is starting to be noticeable, maybe $4,000 a year at 8%. Rung 3 is $100,000. This is the inflection point. Your growth often exceeds your contributions for the first time. Rung 4 is $250,000. At this level, your account is generating $20,000 a year in growth at 8%. You are well on your way. Rung 5 is $500,000 or more. You are in the home stretch. Compound growth is doing most of the work. Most people are stuck on rung 1 or 2 for years. They contribute, but the balance feels stagnant. The goal is to climb to rung 3 as fast as possible. Once you are at $100,000, the momentum shifts. You are no longer pushing the boulder uphill. You are riding it downhill. Here is what you can do today. First, log into your 401k account. Check your balance. Check your contribution rate. Check your employer match. Make sure you are getting the full match. If you are not, increase your contribution percentage immediately. Even 1 or 2% makes a difference. Second, check your asset allocation. If you are young and your money is in conservative investments, consider shifting to a more aggressive allocation or a target date fund that matches your retirement timeline. Third, calculate how long it will take you to reach $100,000 at your current contribution rate. Use an online 401k calculator. Plug in your balance, contribution, and expected return. See the timeline. If it is longer than 10 years and you are just starting out, think about ways to accelerate it. Let's talk about a 7-day challenge. Day 1. Log into your 401k and review your current contribution rate and balance. Day 2. Increase your contribution rate by at least 1%. If you are at 6%, go to 7. If you are at 10, go to 11. You will barely notice the difference in your paycheck, but over time it compounds. Day 3. Review your investment options. Make sure you are in an age-appropriate allocation. If you are under 40 and in bonds, shift to stocks or a target date fund. Day 4. Calculate your path to $100,000. How many years at your current rate? What if you increased contributions by 3%? Day 5. Set up automatic contribution increases. Many plans let you schedule annual increases. Set it to go up 1% per year automatically. Day 6. Check if your employer offers a Roth option. Decide if switching some or all contributions to Roth makes sense for your situation. Day 7. Commit to leaving your 401k alone. No panic selling in downturns. No loans unless absolutely necessary. Let time and compound growth do their work. At the end of 7 days, you have optimized your 401k, increased your contributions, and set yourself on a faster path to $100,000. You are not just contributing. You are building momentum. Here is the final point. The first $100,000 is the hardest because you are building the foundation. But it is also the most important. Once you cross that line, compound growth takes over. Your account starts working for you instead of you working for the account. The difference between retiring with $500,000 and retiring with $1 million is often just hitting $100,000 5 years earlier. Time is the multiplier. Every year you delay costs you exponentially. If you are in your 20s or 30s and your 401k feels slow, that is normal. Keep going. If you are in your 40s and you have not hit $100,000 yet, it is not too late. Increase contributions. Get aggressive. You still have decades for growth. If you are in your 50s and you are past $100,000, you are in the zone. Keep contributing. But now your account is doing most of the work. The myth is that retirement savings is about discipline and sacrifice. The reality is that retirement savings is about math and time. Discipline gets you to $100,000. Compound growth gets you to $1 million. Your job is to get to $100,000 as fast as possible. After that, time does the rest. Start today. Increase your contribution rate. Check your allocation. Commit to the plan. In 10 or 15 years, you will look back at your balance and realize this was the moment everything changed. Not because you got lucky, because you understood the math and played the long game.